Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So this is part 2 of the last video that we did, where we talked about what investments tools to use if you are completely and utterly new to investing in the stock market. Now we talked about 15 different companies that you could potentially use, why you should invest in this type of businesses. We talked about a couple of other things in terms of the type of businesses and so on. And what I would like to do today is to talk about, and we also talked about ETFs, and today's video is part 2. It's going to be a short one, and I want to talk about 2 sets of ETFs that we have not spoken about in that video. So you are starting your investment journey, or maybe you just started. Here are some of the things you should definitely do before you even put money into the market. Okay, now learn the basics. Make sure you understand the fundamental concept like stocks and dividends and market capitalization, the indices, and just learn the basics. Do a bit more research around that and just make sure that you understand. Make sure you know your risk tolerance. Okay, so these companies and the ETFs that we're buying could potentially go up, they could go down, anything can happen. So you need to be prepared for that. If the company that you own is down 20% today, are you going to buy more of that company because you've done your research, or are you going to panic and sell? Because that's what normally happens. The reason why stock markets go down so much, people get worried and they sell it. And that's why you need to think about the psychology of your investment. So you need to think about the risk side of things. When you're investing in the stock market, always think about long-term investment. Don't worry about what is going to happen today or tomorrow to the stock price. If you've got a target, if you bought a stock and you've done your research, or you bought an ETF and you've done your research, and your target is to hold that stock for 5 years, you're not going to worry about what's going to happen in 5 years. So into that company in the next 4 or 5 years, unless fundamentally something crazy happens to the business. You bought it for a reason, and your thesis are still intact, and your target was to hold it for 5 years and see what happens, and that's exactly what you're going to do. I'm not saying just 5 years, but that's probably what I normally tend to do. Now, one of the companies that did that to me early was Merck. I bought the stock, I did my research, I knew they had Keytruda and other cancer drugs and so on, learned a little bit about the business. I bought the stock when it was trading, I think it was $80 or share, $77 per share and so on, but it went down. And I kept buying. I think I bought it when it was in 80 something. So I kept buying and buying and buying, and I hold on to it for a very long time. And look at it right now. I'm up 71%. I'm not saying that's going to happen in every single investment. I'm not saying I'm genius. I've had companies like Medtronic and UPS and so on that's still down. But what I'm saying is, if you got your time horizon, my time horizon for this stock was 4 or 5 years. And within that time frame, it's actually gone up over 71%. So make sure you know that, and try to build diversified portfolio, whether it's just ETFs or stocks and basically or a bit of both. Make sure you diversify. Diversification is very important, and the reason I said that is because if you diversify by assets, for example, or you within ETF and stocks, if one stock goes down, of course you've got, or sector goes down. So like for example in 2022, technology went down so badly, but energy went up quite a bit. So if you had energy stocks in your portfolio, it would balance basic things. Then the next thing is the dollar cost average. Okay, so I've got a video coming up between dollar cost average and of course lump sum or whatever, but dollar cost average just means basically putting money into the market every single week, every single month, however much you can afford. Don't try to time the market. Just buy whatever you can whenever you can. Next thing is make sure you got your emergency fund and all of that stuff as well. Just make sure that your expenses are covered just in case anything happens, and set clear goals for your portfolio. For me, like I said to you guys so many times, for me a lot of it is the fact that I love that dividend income. I want to be able to live off this portfolio and other investments that I have in the long run. So I'm looking for companies that have paid and increased the dividends for 10, 20, 30, 40 years plus. And final thing I want to say is just to make sure that you're rebalancing your portfolio. Be patient, of course, and whenever you got the chance to rebalance. And what that means basically is Some stocks will do well. So for example, right now I've got a couple of companies that have gone above 5%. My target is normally to keep them 5%. If one of these becomes 7-8%, I will sell some and bring it back down, and I will buy more of the companies that have not basically done well, or companies that have not met that target of 3-4%. Okay, so that rebalancing actually kind of helps the channel, basically your channel and your portfolio in the long run. So that's the kind of advice I would definitely give to someone who's new. Even if you're not new, I think that's just basically goes without saying to every single one of us. Okay, now let's talk about the ETFs that we came here for. We talked about these recently, but it's slightly changed because of the, of course, total returns is slightly now different. But overall, these basically ETFs are really good investment, especially if you live in the US. We cannot find them in the UK. So if you live in the US, these are potentially some of the ETFs you should look into. The returns has been all right so far. They do have dividends, so you can, if you live in the US, you get this. Okay, whereas the UK based ones, some of the UK based ones, for example, Halal UK, in the UK is accumulating, so they reinvest that for you, whereas in the US they give you the money, right? So you can see here there's about the top 10 companies make up about 65% of this ETF, and as you can see here, the first 4 are basically heavily weighted on the 4, but it's not like as bad as the other ETFs that I've seen. But yeah, 10% for example for this one is not bad, 9%, and then the rest of them are 2-3%. So this is more similar to the S&P 500 anyway. So this is how the market cap kind of works out. And then you've got the basically the REITs. So this one here again more or less is similar, and you got nice dividend as well. If a lot of the ETFs that we have actually were paying this type of dividends, I would definitely be putting a lot more money into these ETFs, I promise you. But right now I can't do that, and I'm gonna talk about that in the next video, inshallah, when we talk about portfolio update. One of the reasons why I've actually rather have an individual stock than over ETF, because of one of the reasons was because of the dividends. And this one here 1.38, and in terms of stocks in there, similar sort of companies that we've seen with other ETFs, the weighting is more or less the same. This one is a bit crazy because that's about 14% almost, and then the next one is about 4%. So as you can see here, that is the total. So the top 10 make up about 65%, 52%, 75%, 33% for these 4 ETFs. The next set of ETFs that we're going to talk about now is the UK based. So I don't know if they're available in the US, but I think they might be available in other European countries. So just check that out. But they definitely are UK based. Expense ratio is not bad. Okay, so again, hopefully in the next couple of years this will come back down. Year-to-date performance has been okay-ish. It's not as bad as it's not as good as the S&P 500, but it is there, and they don't give you any dividend. They kind of reinvest that for you. And this one here is a bit crazy because you got almost a 30% in Tower Semi, 16% Samsung, and the rest of them about 4-5% or 4%, 2%, 1%, and so on. So you've got Taiwan Semi, Samsung, you got this one, Reliance Industrials. I'm not sure which country that belongs to. This is the non-voting, because they have a voting and non-voting tickers as well, if you like. This is Unilever for some reason. I think that's basically the one in India. And then Al Rajhi Bank, which is basically based in Saudi Arabia, and then so on. So you got quite nicely diversified stocks in there. This one here, very similar to basically the ones that are out there. The other ETFs that we've seen, more tech heavy companies. In fact, 1, 2, 3, 4, 5, 6 companies in tech, but 37% in the top 10. Again, 17% Microsoft, which is absolutely ridiculous. The Europe one, I really like this one. And 5%, 4%, 3%, 2%. That's not bad at all. 6% return this year, year to date. So let's see. A lot of these are actually very, very new. So I want to check it out. Maybe wait for a couple of more years and see where they are. But yeah, right now I'm not definitely interested in any of this. Japan is the next one. And the reason I say that is not because they're bad. It's because I will talk about that when we talk about the portfolio update. There's nothing wrong with these ETFs. And especially if you are new to investing, this is a very good thing for you to do. Why? Because you've got hundreds of companies in one ticker. You don't have to do the research each individual stocks. Whereas if you are buying individual stocks, for example, let's pick one, UPS, for example, you will be down 22% in one go. That will never happen with the ETFs, okay? Unless the whole market goes down, you will not see an ETF that's down 30-40%. Okay, so you have to be careful with that. And this one again, Microsoft to 27%, but the rest of them are actually like more or less distributed when it comes to the percentage wise. 56% in terms of the overall 10%. The top 10 basically make up about 56% of that ETF. And like I said, all of them, you don't get the dividends. And the expense ratio is actually coming down, which is really nice. For hopefully will the next couple of years we'll see 0 point something, 0.1 maybe, or 0.0 something. So that would be really nice. So if you were new to completely investing, I will definitely start looking at some of these ETFs. If you live in the US, if you live in Europe, maybe get hold of this. If you wanna also check the ones that are available in the UK, go and watch that last video, and then you will also see the stocks that we've talked about. So I hope this type of content is really helping you, and if it is, okay, you can actually get the dividend tracker for the ETF tracker, for example, in here. So if you join us, it will cost you about 15p per day. You get access to the Discord and all of these things, as well as the ETF tracker, where you can just put the ticker and then just let it grow, and every single month you can just kind of dollar cost average into that. Kind of losing my voice here. It's been a long day. I hope you enjoying this type of content. If you are, please, just like the videos, subscribe to the channel and let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.